Good evening, everyone. Today was a textbook case of structural divergence in global markets, and I want to walk you through the key signals. Let's start with U.S. equities. The Nasdaq Composite likely managed a slight gain, with the QQQ ETF up 0.61%. But the S&P 500 was essentially flat. The real story, however, lies beneath the surface. The VIX Volatility Index surged 5.5% to close at 18.81. The 10-year Treasury yield jumped 1.47% to 4.42%. And the US dollar index strengthened to 98.97. These three indicators formed a highly synchronized risk-off pattern. The single most important variable today was crude oil. WTI crude oil exploded 8.74% to settle at $108.40 a barrel, directly fueling the energy sector. But at the same time, technology stocks were hammered. Nvidia fell 1.84%, Tesla dropped 0.86%, the ARKK Innovation ETF tumbled 2.54%, and the crypto proxy MSTR plunged 4.54%. Gold also declined 1.01%. Capital is fleeing high-valuation growth stocks and risk assets in a massive way, rotating into hard assets like energy and US dollar cash. Let's trace the path today. During the Asian session, Chinese A shares showed remarkable strength, with the Chi-Next board surging 2.52%, completely decoupled from the prior day's global caution. But then, during European trading hours, crude oil prices started spiraling out of control. Inflation expectations and geopolitical risk concerns quickly overwhelmed everything. U.S. equities opened higher but sold off into the close. The indices barely held their ground, but internally, the damage was severe. The single inflection point for global sentiment today was the crude oil market. The oil spike killed risk appetite. So why did this happen? The core reason is that we underestimated the weight of geopolitical risk. Within 24 hours, the market's pricing priority shifted from interest rates to safety. The oil surge triggered inflation panic, which led to a bond sell-off, sending Treasury yields higher. That in turn crushed high-valuation tech stocks. Money flowed into energy and the dollar. This is a classic macro risk-off trading chain, and it is unlikely to reverse in the short term. Looking ahead to tomorrow, let me give you 5 verifiable predictions. Number 1, the CSI 300 index in China will likely fail to extend today's strength and may see a catch-down decline of 1 to 2%, driven by the triple pressure of worsening U.S. risk appetite, high oil prices, and a stronger dollar. Number 2, the Nasdaq 100 as tracked by QQQ will fall by 0.8 to 1.5% to align with the true weakness of its underlying components. Number 3, the 10-year Treasury yield will remain above 4.35%, as inflation concerns outweigh any safe haven bid. Number 4, WTI crude oil will trade in a high range between $105 and $110, reflecting that a risk premium has already been priced in. Number 5, the VIX will stay above 17, as market fear is unlikely to dissipate quickly. To sum up, today's market action has a 70% probability of being a bull trap reversal. We must immediately lower our expectations for Asian markets to extend their strength tomorrow. Until the cause of the oil surge is identified, abandon any new active long positions. The current strategy should prioritize risk control. Increase hedging positions and wait for the actual market reaction after the Asian Open before making further decisions. If WTI crude breaks below $102 before the Asian session and the VIX futures decline significantly, then the current strategy needs to be reassessed. But until then, remember, safety comes first.